Welcome to the Financial Evangelist Podcast, your source for the latest in economics, crypto, and everything in between. From market movements to blockchain breakthroughs, we cut through the noise and bring you the facts, fast.
Welcome back. Ready to dive into some recent reports and analyses you shared?
Absolutely. Looks like we've got quite a mix this time.
Yeah, it's everything from consumer sentiment and GDP forecast to retail sales, tariffs, even what the Fed's been up to. And a little surprise from the crypto world, too.
Sounds like we've got our work cut out for us.
The goal, as always, is to break it all down and give you a clear picture of what's happening in the economy right now.
And maybe even a glimpse of what might be around the corner.
Exactly. So why don't we start with this pretty dramatic drop in consumer sentiment. That University of Michigan survey really caught my eye.
Yeah, that 10.5% drop from February to March is, well, it's hard to ignore, especially on top of what was already a pretty significant decline.
Remember that video we saw? The commentator called it plummeting? Kind of scary, right?
But what I find even more striking is that it's not limited to just one group. The survey mentions negative sentiment across, well, pretty much all party lines and almost every demographic category.
That does suggest something bigger is going on, doesn't it? Maybe some shared anxieties that go beyond just the usual political back and forth.
It does make you wonder.
And, that detail about people's outlook on unemployment. I mean, being the most negative since the 2008 financial crisis, that's a big deal.
Absolutely. It's not just how people are feeling right now, but their worries about what's coming next. Will they still have a job? Will things get worse?
The commentator in that video even pointed out that in this kind of climate, people aren't exactly pushing for raises. It's like, who wants to risk rocking the boat when you're afraid of being laid off?
Makes sense. Job security suddenly becomes a lot more valuable than a slight pay bump.
Speaking of cautious consumers, we should probably talk about the latest retail sales figures. They seem to be reflecting this whole, hold back and see what happens mood.
Yeah, you often see this pattern. A big drop in consumer sentiment is usually followed by people tightening their belts and spending less. And the most recent retail sales data kind of confirms that trend.
Right. That 0.2% increase in February was way lower than the 0.6% analysts were expecting.
And remember, these are nominal figures. We haven't even factored in inflation yet.
Yeah, so the real picture is even more, interesting.
I think that's one way to put it.
Because, and this is where it gets really important for everyone listening, the January retail sales numbers were actually revised downwards. Quite a bit, actually, all the way to negative 1.2%. So we're definitely seeing a downward trend in consumer spending. And remember what that video host explained. If actual price increases for everyday things, like groceries, were higher than that reported CPI of around 2.8%, or even that 3.1% year-over-year nominal increase, then the real inflation-adjusted retail sales would likely be, negative.
Yeah, that's a crucial point. When you factor in the real cost of goods, the picture gets a bit dimmer.
And considering that consumer spending is, around 70% of the U.S. economy? I think that's what one of the reports said.
Yeah, about that. It's a huge chunk.
So a decline in real retail sales, that's definitely a red flag. Makes you question how strong the economy really is right now.
It does raise some fundamental questions. I mean, if people are already cutting back before we even fully account for rising prices, that suggests households are feeling the pinch. And they're probably getting more careful with their budgets.
Like that drop in spending at food service establishments. Biggest decline in 2 years, right?
Yeah, according to one of the reports, people tend to cut back on those kind of discretionary expenses first when they're feeling financially squeezed.
Okay, so we've got consumers feeling less confident, spending less, and all of this is happening while experts are revising their GDP growth forecasts downwards. What are the financial institutions like the Atlanta Fed and those big Wall Street banks saying?
Well, what's striking is the growing consensus that economic growth is slowing down. You see it in the Atlanta Fed's GDP Now tracker, that real-time estimate of GDP growth based on incoming data. Initially, it showed a pretty notable drop, even dipped into negative territory for a bit there after factoring in the latest trade figures.
It's bounced back up a little since then, right?
Yeah.
I think they got some better payroll data.
Yeah, it's edged up slightly, but the fact that it was hovering around 0 or even below is a pretty big shift from the more optimistic projections we were seeing earlier.
And it wasn't just the Atlanta Fed. We saw Morgan Stanley and Goldman Sachs, those big Wall Street names, revising their GDP growth forecasts downwards too. So what's behind all this pessimism, I guess?
Well, the sources you sent highlight a couple of key concerns. First, tariffs. They're being mentioned more and more as a potential drag on economic growth.
Right, Goldman Sachs specifically mentioned larger tariffs hitting GDP harder, something about a tax-like effect on disposable income and consumer spending.
Yeah, that's a good way to put it, because when tariffs push up the prices of imported goods, consumers have less money left over to spend on other things. It's like a hidden tax that reduces overall demand.
Like if the cost of your new washing machine goes up because of tariffs, you might have to hold off on buying that new TV. Makes sense.
Exactly, you're essentially shifting money around. And while sometimes recessions are triggered by sudden shocks, like tariffs, what's interesting here is that a lot of these institutions are also talking about a more fundamental weakening within the real economy.
One report mentioned weak spending, weak incomes, weak retail sales, falling consumer confidence. It's like everything's pointing in the wrong direction.
And that suggests a slowdown that was already in motion before the full impact of these potential tariffs even kicks in.
So it's not just about trade policy. There are deeper issues at play.
It seems that way, yes.
Okay, so we've got consumers feeling down, spending less, experts lowering their growth expectations, and tariffs looming as an added pressure on top of existing weaknesses. So what about the Federal Reserve? How are they reacting to all of this? What's their game plan?
Well, according to that FOMC statement you shared, they seem to be aware of the increased uncertainty.
But they're holding steady for now, right? Keeping interest rates where they are.
That's right. They're essentially taking a wait-and-see approach, monitoring the data to see if this slowdown gets worse or if inflation sticks around longer than expected.
But there are some pretty strong opinions about whether that's the right move, right? I mean, one video even called the Fed's inaction detrimental with the economy potentially heading toward recession.
Yeah, that's a pretty bold statement. But it reflects a concern that's out there, that the Fed might be making a mistake by not acting more aggressively to counter these signs of a weakening economy.
Because if households are already struggling, and we know they are, I mean, auto loan delinquencies are at levels we haven't seen since 1995.
Wow, 1995, that's a long time.
Right. So the argument is that keeping interest rates high just adds to that burden. It makes borrowing more expensive and makes it even harder for people to get credit.
That's the logic, yes. If you're already struggling to make your car payments, higher interest rates aren't going to help.
And remember that stat about the perceived likelihood of being denied credit. For credit cards, auto loans, mortgages, it's at its highest point since 2013. That tells you something about how tight credit conditions are right now.
It definitely suggests that lending is becoming more restricted, which could further dampen economic activity.
And it's interesting, isn't it? Because the Fed's approach is totally different from what other central banks around the world are doing.
Yeah, it's almost like a race to the bottom in interest rates. Several countries are already cutting rates in response to similar or even less pronounced signs of economic weakness.
Like the Bank of Canada. They had a surprisingly high CPI report, but bond yields didn't really budge. It's like the market's already anticipating more rate cuts, despite inflation concerns.
It seems like the prevailing thought in a lot of places is that the risks to economic growth are outweighing the immediate risks of inflation.
So the Fed's kind of going against the grain here. And one of the videos even quoted an economist who basically said the Fed needs to get in line with what everyone else is doing and seriously consider cutting rates if this slowdown continues.
The worry is that by not easing monetary policy, the Fed risks making the economy even weaker, maybe even pushing it towards a recession.
The logic is that lower interest rates would make it easier for people to pay off their debts, which could then encourage more borrowing and spending and give the economy a boost.
That's the theory anyway. But, as one of the videos pointed out, it's not a guaranteed solution.
Right. Cutting rates might not work if the problem is that people just don't want to spend, or if banks are too worried about borrowers defaulting and stop lending money altogether.
Yeah, like what's happening in China. They've cut rates, but it hasn't really led to a huge surge in borrowing, so it's not a sure thing.
Okay, before we wrap things up, let's touch on that surprising news about the SEC and Ripple, or XRP. That could have some pretty big implications for the crypto world, couldn't it?
Definitely caught a lot of people off guard. The reports that the SEC is dropping its lawsuit against Ripple caused a huge spike in the price of XRP, and a lot of people in the crypto community are seeing it as a major win, one that could really change how digital assets are regulated in the U.S.
It's got to be good news for anyone who's been holding XRP, especially with all the uncertainty in the economy right now.
It's an interesting contrast for sure.
That video commentator even suggested it could open the door for an XRP exchange-traded fund,
Mhm.
an XRP ETF. That'd be pretty big.
It would certainly unlock a lot of potential demand. Whether it has a ripple effect on the wider crypto market, well, that's still to be seen, but definitely something to watch.
Absolutely. Okay, last thing. Let's talk about how the impact of tariffs could vary depending on where you are in the country. There was that map, remember, showing which states are most vulnerable based on how much they import from Canada and Mexico,
Yeah, the differences were pretty stark.
like Montana. Something like 93% of their imports come from Canada and Mexico. So tariffs on goods from those countries would hit them hard.
Compared to a state like Hawaii or New Jersey, where the import shares are much lower, even a big state like Texas, almost half their imports are from Canada and Mexico, so they'd be significantly affected too.
It really shows how national policies can have very localized effects, doesn't it?
Absolutely. Trade isn't just a national issue. It plays out differently in every region.
And, that analysis only looked at Canada and Mexico. If you factor in potential tariffs on goods from China, which is, well, kind of a big deal in global trade,
Things could get even more complicated.
plus there are all those exemptions and the fact that trade policies are constantly changing makes everything very unpredictable.
It's a good reminder that when we talk about big economic policies, the real consequences can vary a lot depending on where you are and a whole bunch of other factors.
So what did we learn today? What are the key takeaways from all these reports and analyses?
Well, it seems like there are some real warning signs flashing. Consumer sentiment is down, retail sales are weakening, and a lot of experts are predicting slower economic growth.
And tariffs are adding to the uncertainty, even though there seem to be some deeper economic issues at play as well.
The Fed's taking a wait-and-see approach, which is a bit different from what other central banks are doing, and that's raising some concerns about whether they're doing enough to support the economy.
Meanwhile, the news about XRP is a bright spot for the crypto world, even if it might not signal a broader trend. And it's important to remember that the impact of potential tariffs will be felt differently in different parts of the country. Some states are much more exposed than others.
The big question is, what happens next? Are we heading for a recession? Will the Fed change course? How will all of this affect you and your finances?
These are all things to think about. And here's one more thing to consider. We've seen this divergence in monetary policy between the Fed and other central banks. What do you think that means for global interest rates in the coming year?
Definitely something to ponder.
Absolutely. Thanks for joining us for this deep dive. We'll see you next time.
Tired of spending countless hours sorting through your crypto transactions? Meet Coinly, your all-in-one crypto tax solution. Whether you're trading, staking, or mining, Coinly automatically imports and categorizes your transactions from over 700 exchanges and wallets. Generate accurate tax reports in minutes, track your portfolio performance, and stay compliant with your local tax authorities. Coinly supports tax regulations in more than 20 countries, making crypto tax season stress-free for investors worldwide. Join over 1 million users who trust Coinly with their crypto taxes. Visit the link in the description to get started today and receive 20% off your first tax report.